Most of the funds in our space are corporate VC funds. Gordon Food Service, Chipotle, Tyson Foods, they have their own VC funds. There is some GP non-corporate VC funds, but they don't really have that operator angle. Both myself and my partner, he was a hardware entrepreneur and a mechanical engineer, material science guy. So we can look at things a little differently than other people. When the rubber hits the road, we can add a lot of value to our startup. So I think that we really differentiate ourselves that way. It's a very collaborative environment, the food VC space, because it's a little bit niche. We try to be pretty agnostic where our technology has an opportunity to move potentially outside of food as well. We can still have that mindset of a big venture return because that's where we were trained. We were trained in Silicon Valley, so we're not looking for like a private equity type of 3x deal. The deals we do we really feel are 50x type of opportunities. So try to be smart about picking those industries and being like infrastructure plumbing and not CPG focused. I think that differentiates us significantly.
Cam, welcome to the Slice Pod, where we uncover the stories of fresh emerging managers across the early stage venture landscape. You are the co-founder and general partner of Redstick Venture, a $5 million fund invested in pre-seed and seed stage companies focused on sustainable food production and labor efficiency across Canada and the US. Let's begin where we always do around here, and it's by asking, how do we get to this point? Was this always the plan?
No, definitely not. I fell into this by necessity of my former business. I was a Tim Hortons franchisee in Canada. I had 6 locations, 200 employees, and it really started to get difficult to get labor in the restaurants and manage it. So I started to make investments as an angel in advanced technology type companies and really started to fall in love with what the opportunity presented itself around food and labor efficiencies and things like that. Definitely an interesting story of how I got into it.
How does one go from having a labor shortage in a franchise model to cutting angel checks? Did you have any adjacencies to the venture world? Did you get pitched by these startups, their products, and you were like, you know what, this actually makes sense. Let me cut you a check.
I called a friend who was in economic development in Canada and said, how do I put robots in Tim Hortons? That led me down a road of meeting about 10 startups. The last startup I met was from Silicon Valley that moved to Canada and was in my hometown of Tecumseh, Ontario. The more I started to talk to them, I started to realize how the application of vision would work in a restaurant. We did a pilot in Tim Hortons and I had the number 2 drive-through time in Canada because of the speed. And that's when the light bulb kind of went off of some of these advanced technologies, the cost was reducing and it fit more into the food landscape. Got the bug after that. I started to get involved in angel networks and that's how it started.
And what was the aha moment that went from like, I'm cutting an angel check here and there, testing technologies to, you know what, this should be a fund. This should be an institutionalized pool of capital. I need to do it systematically.
I went out to Silicon Valley. I worked at a venture firm called VU Venture Partners. It's like an accelerator for angel investors to get into VC. I went out there with the idea of starting my own company. Then I started to realize there's a significant risk for failure in starting a high growth startup. While I was doing venture deals, it made more sense to do a fund versus one company, applying my operational experience to startups. There's not a lot of people like me that have run restaurants, worked in a big chain, and understand what makes sense. That's really where it started. At that firm, I spun out with my business partner who I met at that firm to do our own thing and start the long process of raising capital with LPs.
For institutions and your very kind of untraditional path to venture, how did you find the first couple of LPs? Who are these people? Fellow angels from Silicon Valley, friends and family, other Tim Hortons franchisees?
At first, when I sold my Tim Hortons business, a lot of people were like, okay, what's Cam got up his sleeve? I was one of the youngest franchisees and always innovative on new technologies. By going out to Silicon Valley, doing venture deals and understanding what a venture deal looks like, coming back to Canada, and my partner went back to St. Louis, we felt that we could unlock some capital that didn't have access to Silicon Valley or venture deals. So yeah, we have some people that are Tim Hortons franchisees. We have some people that are angel investors in the Canadian and Midwest ecosystem, really high net worth traditional business owners that typically wouldn't think about having venture capital in their portfolio. We've spent some time educating our LPs on the benefit of having 5% of your portfolio in a high growth opportunity. We have some significant net worth people that we feel if we continue to do a good job, we can get them to put more money in and show them that we can prove out what we're doing.
Very curious about what you think pushed those folks over the edge when it came to not just entertaining the idea, but also committing to it. Because as you said, it's maybe not necessarily something they're educated about. There is a lot of things that are different about this asset class. What was the dominant theme that you feel these people resonate with?
I think initially it's like founders in a startup. People really believe in myself and my partner that we can do things. We've been successful in our life in different avenues. And they looked at it that I was kind of betting my life on this next move. I think if you have that level of conviction, you burn the boats and the things you've done before to move into that next thing. I think that helps in this type of world. The interesting thing in food is that everybody eats food, right? Everyone's had an experience at a fast food restaurant that was unpleasant or got sick with food poisoning or saw some garbage on the side of the road of non-sustainable packaging. So I think that going after traditional business people and doing something like food, they could understand it versus a high growth social network app. I think that resonated with our pool of capital. It's something you can touch and feel. Everybody's having these labor problems, right? And then especially like the service in these industries around food. You could touch on that pain point and say, hey, when was the last time you went somewhere and had bad service? And it's like every time I go somewhere. So that was kind of our in to starting that conversation.
And what do you think it's sort of like the competitive landscape, both from a thesis point of view and from a capital network standpoint? Because you don't have any competition with these folks because they don't invest in venture funds. And so like you're the only opportunities they're evaluating. Do you see other very early operator-led small pre-seed and seed funds that operate in the same category?
No, I think we're pretty greenfield. Most funds in our space are corporate VC funds, Gordon Food Service, Chipotle, Tyson Foods, they have their own VC funds. There is some GP non-corporate VC funds, but they don't really have that operator angle. Both myself and my partner, he was a hardware entrepreneur and a mechanical engineer, material science guy. So we can look at things a little differently than other people. When the rubber hits the road, we can add a lot of value to our startups. So I think that we really differentiate ourselves that way. It's a very collaborative environment, the food VC space, because it's a little bit niche. We try to be pretty agnostic where our technology has an opportunity to move potentially outside of food as well. We can still have that mindset of a big venture return because that's where we were trained. We were trained in Silicon Valley. So we're not looking for like a private equity type of 3X deal. The deals we do we really feel are 50X type opportunities. So try to be smart about picking those industries and being like infrastructure plumbing and not CPG focused. I think that differentiates us significantly.
I think some of the marquee logos that come to mind, like the Toast, the Squares, the DoorDashes of the world, have been potentially the biggest winners in the space. You mentioned labor a couple of times, and you mentioned that you came to this because you were like, okay, like I need some robots and this joint. What are the other unique opportunities, besides verticalized payment solutions and logistics, labor, as you said, but packaging, I think you mentioned, like what sort of like the areas that you think you can find those 50X?
Well, I think for sure in the hardware side, I really think investments moving from bits to atoms. And I feel that in the labor side, in our portfolio, we have 3 robotic companies now, more along smart appliances that can be plugged in Burger King, something that would cook all the burgers automatically where there's no labor and there's no skill to do it. And we're in a declining population. So that we feel is a huge opportunity for these companies to scale their processes and optimize. We're super bullish on that. Also AI agents, there's AI agents in like recruiting and things like this. And I think really in food, the winning formula in AI agents is going to be deep vertical experience with these agents. And we feel there's opportunity in food that not a lot of people think about. There's an opportunity to find companies going after an AI solution in markets like a food processing plant or a quick service restaurant management app. Other firms would probably go somewhere else, but we view it as one profile that we need to sell to, and we could sell to, 5,000. There's 5,700 Tim Hortons in the world. You build one of them, you got a pretty good client base and you can scale it out. So I think those would be the two things that really make us excited. And then sustainable packaging too. I think the market is ginormous. Microplastics are a big problem. So I think that's a space. And then the fourth one would be GLP-1s. There's a lot of opportunity in functional foods where taking an Ozempic shot is maybe not for everybody, but there's like functional ways to kind of like internally get that going. We're looking into that market as well. Those would be the four big ones.
How do you think about portfolio construction within $5 million fund?
Yeah.
What sort of valuations do you get in, and what kind of exits do you expect relative to the number of investments that you're trying to make? Or is this just more of a proof of concept vehicle where you're showcasing taste and access and you're not necessarily looking at the underlying economics?
We're definitely looking at the underlying economics. Like we'll do 30 deals out of this fund, roughly around 125K average check. We're really valuation sensitive. We think sub 10 for sure is something we would need to get into unless the market makes sense for us. In every investment we make, if we write $125,000 check into it, we're looking to return the fund with every single investment we make, and we underwrite it to that. So we're a small fund, first time fund manager. We wanted to show that we could get into the top level deals in our space. Our goal would be to lead deals in our next fund and write 750 to $1.5 million into a company. We really think there's a lot of opportunity to do that because there isn't as many players in our space that know it as well as we do. A lot of times we'll identify deals that we like, but we can't do it until a lead comes in and sets the terms and we follow on behind. There's benefits to that strategy, but we think we can be the leader in the space, write first checks and get our network around these deals. That would be our goal. We're training Silicon Valley, looking for fund returners on every single check that we write into it. That's our strategy.
You touched on it, which is the idea of where does this go next? And you mentioned the next fund would be good to be in a spot where you're not following someone else's lead, but you can be the lead. Is that the dream to go from a $5 million fund to a $25 million fund to a 50 to 100 and become a platform for this specific corner of the market? Or do you think that there is beauty in staying small and nimble and under getting in at that sub $10 million valuation? Because if you're doing a $1.5 million check, you'd want the company to be potentially a little bit more structured, a little bit with a stronger grip on their business model and their revenue. And so you're potentially missing on that multiplier. You were mentioning of potentially returning a whole fund with one single check and every single one of those checks being able to do that. How do you think about that between staying small and growing it?
It's definitely a conversation internally about this because we feel if we go to that bigger check writing number, we have to go to more of a Series A type of investment. Based on the deals that we have now, focused on pre-seed and seed, it's a natural transition. We've probably got more visibility to see these companies for 3 to 5 years and see which ones we really want to back heavily. The other angle is that you could do these sub $10 million funds, get experienced operators in a certain vertical and deploy capital the same way. Like I'm lucky to be a member of the C100 in Canada that connects Silicon Valley to Canada. We have significant deal flow outside of food that we could tap into, put GPs in smaller AUMs and keep running this follow-on strategy. We'd have both those balls in the air right now. The way to move forward, we want to return capital to LPs. And I think that's the most important thing in our business. We want to make an impact on the world too. We're moving into bits. We're going to have real world problems that we need to solve. Because of our angle, we could change the world with the checks we write and back the founders that we think are really going to do that. So it's an internal thing. We definitely need, if we go bigger, we need a big institutional LP to come in and anchor our next fund. And if that happens, I think that sets us up in a really good spot to go after that bigger check. So we'll see where it goes.
Do you think big institutional LPs appreciate the corner of the market that you're going after and understand it the same way that your smaller LPs do?
I think it's a different conversation, right? They're definitely more risk averse, the bigger ones. They don't want to be made to look stupid. I think what we've done is We're probably like, I mean, we're an early stage fund, so it's weird to say that we're probably a little bit early, but if you start to look at where the market's going, humanoid robotics is like taking off like a rocket ship. We were kind of a little bit ahead of that, I think, with our kind of way we were investing in hardware. And people said, don't do hardware, it's too capital intensive. Well, there's a lot of money going into hardware right now. I think the way we're positioning ourselves and the deals we're getting in sets us up for this next fund in a really good way. And I think the institutions that we've had this conviction and it's starting to come to fruition, I think we've had these conversations with them already that they're interested in what we have going on because we are a bit different than most funds in the way we look at things.
It seems like decent chunk of the deals that you've done to date come from, let's call it, food tech accelerators and startup aggregators. How do you balance sort of like the sourcing motion of like, finding something that it's already out there versus like going actively looking for somebody solving a particular problem that you're aware of because of your background versus taking a bunch of inbounds, which at some point, perhaps you already have a lot at this point, but it will grow over time. What's your sourcing approach and where do you think you find the best value in terms of time spent being a small firm of only two people? Obviously you cannot spend hours and hours diligencing every single opportunity that comes through your desk.
Yeah. There's kind of two parts to that. We definitely look for white spaces. One of them was sustainable packaging, and we went out and did this orthotic deal that had a really interesting angle to sustainable packaging. I'll credit my partner for that. Another example would be lab testing in food. We felt there was a big opportunity. It was super expensive. You have to send it somewhere. We just did this deal, Spectacular Labs, that is like lab in a box out of Silicon Valley. So those would be like kind of more of a hunter mentality type of deal. Because of our strategy, we have a good relationship with other funds and we work hard to build our network early with funds. They get that trusted deal, whether it's through a fund or our founders have been great referrals for us. If we're getting it through someone we trust, I think it definitely perks our ear up, especially people that know us and understand the kind of deals we like. It helps filter it for us. But we have a process. We put them in the funnel and we go through a partners meeting on Monday and check what deals we like. We have a startup snapshot of the key metrics we want to go through and if they meet. And then we make a decision, me and my partner, to move forward and gather more materials and go through the line. And in our strategy, we're lucky to get DD from other firms too, where we can cross-reference what we think with what they think. And that helps with our strategy. So we definitely run a very disciplined funnel, but those inbound referrals are always going to hold more weight for sure.
I'm assuming that one of the reasons why you get those inbounds obviously is not because of the 100K check, but because they can shill you to the founder as somebody that brings value to their cap table. What is the pitch that you think these funds and these founders give to the potential investments that they bring?
Yeah, I think they know that we punch bigger than our check size, right? And that we give, I think what gets lost a lot of times in investment is how much this is a people business. You're really betting on the people. Like we're asking entrepreneurs to chew glass and stare into the abyss. So you're looking for people that have perseverance. We've kind of done it before. I had 200 people that got paid minimum wage and it was a tough business to run. My partner, same thing. He traveled all over the world selling tools and designing his own equipment. We've done it before and have a sense of empathy as well. We raised our own fund from scratch in a new industry and raised our own fund. And so I think that they kind of trust us there. And I think like depending on what type of deal it is, we can add a lot of value. Like my partner on the hardware side, supply chain, understanding how to work on like prototyping cheaply and where to go for that, and whether it's China or going to Costa Rica, myself and maybe like their pitch and how they would like kind of frame it towards someone that they're trying to sell it to that's running a P&L in their business. So I think everybody's got a different angle, but I think most our founders would say that we're very relatable and that if they ever need anything from us, they can call us and have a conversation and not feel like they're being judged on that call. I guess that would be how we operate.
And you mentioned that you have kind of a punch list in terms of metrics and verticals when it comes to your diligence process. What matters the most when you invest? Is it just a person? Like if I bring in an exceptional founder, terrible metrics, terrible business by consensus, would you still do the deal just because you believe that they can chew glass for many years to come? Or do you still require some sort of underlying fundamentals to make sense in order to underwrite a deal?
I don't know if we've ever turned down a deal with a founder that we were completely in love with. And none of those deals have gone bad. Like even from an angel investment, my track record, like the people that were unbelievable, they're always going after, very rarely are you going to have that level of founder that isn't going after a pretty big opportunity because they have options to go after multiple things in their life. Sometimes you may not understand it and you may need to spend more time with the concept to really get your head around the problem they're solving. So again, I think it's a people business first and foremost, but we definitely look at the market and try to understand, is it going to be an easier market to grow a big business in, right? I look for these niche opportunities to start where they can get a land grab in this niche opportunity first. It may feel like it's a smaller market, but they can go in, crush it in that market, not have to spend a ton of money on marketing to expand. Once you get that cash engine going, especially in hardware companies, you're off to the races at that point, right? So I like those type of deals versus like ginormous market and you're trying to get the whole thing because there's a ton of competition in those markets too. If you can carve out something in that smaller market, that's definitely where I like to play. But it always goes back to the people. If you do a post-mortem on every negative investment you've had, the people are going to be top of the list. Number two will be some type of market issue where the adoption just didn't happen or the economics weren't what they thought once they got into it. But most times it's going to be the issue is the people.
Going back to that first angel investment that you made, that very first check, and thinking about the last one that you made through the fund, how has your investment acumen evolved over that period of time? Do you think that there has been some trends or some big pivots or some big revelations?
I had no clue what I was doing when I made my first investment. I spent a lot of time understanding the valuation. It was so different to understand this company's got 100 grand in revenue and you're telling me it's worth 7 million. I'm going to write a safe agreement and not own any of the company until someone else tells me what it's worth. It just like was a crazy concept to me. Sometimes it still is, but I get it now. I'm a professional investor now. This is what I do for my career. I live this every single day. I look at, 100 deals a month or 50 deals a month. It's what I live and breathe. I feel like I know the market. It's a totally different game than when I was first doing it. I think what helped me in my career was that I had so many reps with people. It's a different game dealing with people that have PhDs in nanoscience and, engineering, AI engineering backgrounds and things like this versus a minimum wage Tim Hortons worker or a manager at Tim Hortons. At the end of the day, it's really like incentive based in my mind. And I think if the incentives are aligned and it's something that intrinsically someone wants to do, especially in venture capital and the startup game, it's like being a professional athlete. You really have to have intrinsic motivation to do it. We try to get to the bottom of that. As much as it's a digital world now, we try to get in front of the founders, even with a small check, and have dinner with them and shake their hand and understand what makes them tick. And I think that that's kind of my advantage that I've dealt with people so much. More professional as an investor now, but still the same core qualities. It's a people game. And understanding people is going to be my superpower.
What does the future of food tech looks like to you? If everything you invested in becomes a success, what world do we live in at that point?
I think we live there's two main things that I think about. So one is typically when we talk to investors or LPs, they're like, what are people going to do for jobs with what you're doing? I view it as that when you go to a restaurant, you don't really know what happens in the back. You want to have a great server at the front. Right? In food, a lot of these jobs are very difficult. I view it as we're creating the infrastructure that's going to allow people to do the things that are really meaningful in food and create that personal connection. I think that's one of the biggest things when we talk about our hospitality side of the portfolio. The cost of food has the potential to go really low if we build infrastructure around automation and growing food more efficiently, getting higher yields, using AI to leverage that. I feel that the quality of foods should significantly improve over the next, 5 to 10 years where we're getting like, instead of going to McDonald's and getting a unhealthy meal in a short amount of time, we're getting a drone delivered healthiest meal based on what your body type needs. That's where I would like to see it go. I would like to see it that cooking is something we do for fun. We don't have to cook, and we could get that same quality of meal for a lesser price than if we cooked it ourselves. I really think that's where we're headed.
Love that. And how do you split your time? Portfolio of 30, probably going to stack another 30 on top pretty quickly. There are two of you, and you said you pack a punch bigger than your check size. What does that mean? What do you actually do for them and for your lifetime?
It's case by case. One of my GPs at BU was early at Facebook, Twitter, Uber, all the big companies. He said, make sure you're spending your time on the companies that actually are benefiting from your time. You can get bogged down spending too much time in the companies that aren't moving forward. At some point, you have to focus on the companies that you can really move the needle. So I really try to spend Wednesdays and Fridays on portfolio. A lot of that is corporate development, talking to other corporate VCs, talking to other corporations. We try to build relationships with those brands, whether it's Post Cereal, Tim Hortons, Gordon Food Service, or companies like that, and ask what their challenges are and see if we can get our companies in there. We also do a lot of networking with companies in food that are further along than us that maybe our companies could come behind, because a lot of these big brands don't necessarily want to work with a brand new startup right out of the gate, but they're happy to work with a startup that's at Series B, Series C. A lot of times our companies can fit into what they're doing. It's really a networking game. And as a venture capitalist in this space, I feel like we sit in the middle of founders, our LPs, and these corporates. A lot of these corporates are companies that could buy our companies too. We haven't got to that point of selling a company yet, but I feel like we're building awareness within our portfolio of, hey, we're doing this, it can help you now, and down the road, maybe it's something you want to acquire.
Any portfolio darlings?
I would say Science on Call, and I know Sungwoo knows them. They are just fundamentally crushing it right now on the sales side. We're excited to see the venture market hasn't given them credit on this next round yet, but I feel they're at an inflection point where their gross margin is going to be solid. They've tripled their sales since we invested. Great team, super high integrity, just good people. And then Gastronomist, that was our first check-in. They're in a big coffee chain now that has 5,700 locations, and they're doing great. The metrics are doing really well. So there's still a long road to get it across the whole chain. But the hardest part with these big brands is getting in as a startup. And they've been relentless in the way that they pursued that. So those would be the two that we look to right now that we think are doing well. And those are our two earliest investments as well.
Talking about the early days, what were some of the biggest challenges transitioning from your, franchisee operator days to the full-time investor that you're doing right now? I know you've been an angel investor for a brief period in between, but even that, it's quite different from what you're doing at this point in time. What were some of the things that you wish you knew at the beginning of this journey that now you think that, oh, I should have over prepared for this thing, and that other thing that I thought was going to be so important actually didn't turn out to be quite as fundamental as it?
Yeah, I'm a no regrets guy. I think you end up where you end up because you had to learn those lessons. But I think like going from an operator, you have to think a little differently. I did coach a little hockey, so it is more like coaching than operating. You can lead a horse to water, but it has to drink. You have to be more like coaching kind of versus like, I'm just going to do this and take care of it. And that is like a little bit of a different thing. On the fundraising side, you learn it's a totally different game, fundraising, where you're dealing with people's money, which was different than what I did before. You see some really weird things with people and how they react with money. There's been people that make a commitment, sign an LOI, and they ghost you. You start to get calloused in your approach of talking to people about it. It's hard to explain, but unless you go through that fundraising process, I tell all our founders or founders we meet, it's like, you guys have such an advantage. You're selling a widget. You're going to need this money to build this widget. We're kind of selling the theme of investment that we don't really know what the returns are. We also got stuck in a horrible timing environment. Be very aware of interest rates and the markets before you raise. I would be very smart about timing when I raise my next fund and understanding the hype cycles of venture. I was out in Silicon Valley at the top of the bubble. and my GPs were trying to raise and going really hard. But then I thought to myself, you have to get the money, right? And raise in the hype cycle and invest when it's in the down cycle. So I feel like our returns are going to be really good because we're investing in the down cycle. So I think you have to be smart about that. That would be my biggest lesson. We made a little bit of an error of educating our investors, but I also think it'll benefit us in the long run because there's a trust built up and we can all make introductions to other funds to help them with their portfolio. And I think if you always do the right thing, it'll work out for you. On the investment side, I think it always comes back to people and you learn to get better at reading people, reading markets. There's so much there that's even hard to point out, you know?
You mentioned it's the networking, both on the fundraising side and support and sourcing and everything. It's quite next level intense. How do you keep all your ducks in a row? Given that it's just a tool,
Yeah.
very little support, like you're not a large firm with an army of associates, expensive CRM systems and whatnot. What's the stack look like? What are the rituals? How do you guys keep organized?
We're a VC Labs fund, so that definitely helps. We have a CRM that's like specifically tailored to venture. So we have like a fundraising, companies, connectors, all through their Decile Hub system. They're continually evolving the system based on like what we ask for. Like even the CRM on the deal side, there's like these cards that we've like helped them create and the feedback that like makes it really easy to understand valuations are and what they're going after. But I think we're founders, just like a startup founder is. Like you have to do a lot of that yourself to understand. So we've been lucky that we built a partnership with the University of Windsor and Wash U out of St. Louis, where we have MBA students that work for us on a project basis for 8 months. With the University of Windsor, there's an Apex program where they come in for 8 months, typically 5 MBA students. And because we're venture capital, every MBA student wants to work for us. We're getting the top people and we get to pick which ones we want. So they'll do like market mapping, potentially looking into like some investments that we want to look at. It really depends on the skill level of them. And then we get to pick one or two that work full time for us from August to December. This is the third iteration of this. So we've got really good at onboarding them and like teaching them about venture. We want you to read these two books. Here's our onboarding for redstick and all our email templates, everything like that. We recently brought on an executive assistant to help with managing schedules and things like that. But we are very, like, I'm very like system guy. So, at the beginning it was kind of difficult to like have to do it all yourself, to be honest, because I'm so used to having like people underneath me. So now at this point, as we look to close our fund, move into the next fund, we're looking at scaling it out. We've trained 9 MBA students that could definitely come into our fund and know exactly what we're looking for, know what we're like as people.
What piece of advice would you give yourself coming into this when it comes to the actual day-to-day management of the firm?
I think time is the biggest thing, right? You can lose a lot of time if you're not spending it in the right place. Getting an executive assistant's really helped me with that. She runs my calendar now. I block it off and say, protect my calendar. I think that helps a lot because before I ran my own business, I didn't have anyone. This is very external facing. So people want to take your time from you. You really have to protect your time and make sure that if you're meeting with a company and spending the time that you're interested in it and what they're doing. Sometimes you can learn a lot on those calls. I have been going back to a couple more of those a week where it's like, I don't think I'm really interested in this, but you learn something on all these calls.
The random walk.
That's a good way to look at it.
How do you and Shane split the day-to-day? Are you guys sort of like mirror of each other when it comes to roles and responsibilities, or does one do more of the top of funnel, the other one the due diligence, one is more LP focused, the other more portfolio focused? What's the split of roles with a co-founder when it's this small?
Shane really handles the due diligence side of things. I'll handle more of the outreach, networking, LP stuff. He'll handle the technology market angle. I focus on the investment side, reading a lot about where the future is going and conceptualizing where companies could end up. I spend more of my time reading books about AI, where he's more focused on, he's an engineer, so he thinks like lining it out. I think a little bit more visionary with our investments. When we go through our process, we find the companies meeting at that intersection of grounded in reality and sci-fi. And then we feel like when we get to those points, those are the best deals that we do. I'm more focused on the networking, but he's also good at it too. We can do both. He's definitely important on the due diligence side for sure.
What's the best way to get in touch with you if I'm a founder or an LP and I heard your spiel and I like what I heard and I have something for you? Are you an email kind of guy? Are you a LinkedIn, Twitter, DM?
Yeah, I'm an email guy for sure. So cam@redstickvc.com.
This is a signature question we tend to ask towards the end. What is the one thing that we didn't touch on that you prepare for and you're going to walk away from this call and be like, damn it, I blew my chance to let the world know about this great insight, the vertical, the space you invest in, the size of checks you do, the type of people you work with, that you believe it's not a well-known truth of your world?
That's a great question. I think there's two things. One is people are really sleeping on the birth rates in North America and the world. We're not going to have enough people to work in these industries once the baby boomers fully retire and the millennials and Gen Zs continue to not have babies. We're headed towards a pretty apocalyptic scenario if we don't increase our productivity across North America. So the Asian countries are in a very similar boat. The sustainable birth rate is 2.1. We're at 1.65. You extrapolate that over 20 years, we're in a really bad spot. I think we're really lucky that technology's amplifying here. We can get out of this with technology essentially. So that'd be one. And then just from our perspective, we like working with good people and we prioritize that. So, if you're a founder, an LP that looks to invest or work with people that are high integrity and want to have fun while they do it, like that's definitely us. And that's the people that we kind of want to work with. So I think we've spent a lot of time in other careers of working with people that were not aligned with us. We want to work with people we want to work with. Those would be the two main things.
I'm sure you've rejected investments before. Have you ever rejected an LP
Yes,
check?
we have rejected an LP check before.
What was
Along the lines of integrity. We just didn't feel like it was someone we wanted to work with long term. We made that difficult decision, and it was the biggest check we would have had written into our fund. It was a difficult decision. I feel like if you just do the right thing, it works out for you at the end. So that's what we did.
We'll talk more, I'm sure. Congrats on redstick. I really love the story where it comes from, and you're a true entrepreneur. So I think that resonates with your founders for sure. And I think this is the beginning of a firm.
Thanks, Fabry. Appreciate it. Samu, appreciate it.
You've just listened to another episode of Slice Season 2, the podcast for emerging managers. Special thanks to Nicole for introducing us to Cam, and also to Cam for joining us on the podcast for the conversation. If you enjoyed this episode, we have a lot more emerging managers along the way and episodes that we've already recorded. You can find them on our Substack. So make sure to subscribe, and we will see you next time. Bye.